Have you ever wondered if you could outsmart the stock market? The efficient market hypothesis says that it's impossible. But what if I told you there are cracks in the theory that savvy traders exploit every day? The efficient market hypothesis is the theory that financial markets are efficient, meaning that asset prices fully reflect all available information at any given time. This implies that all prices, for instance, bonds and stock prices, fully reflect all information and always trade at their fair value. In other words, it's impossible for you and me to consistently beat the overall market returns. In simple words, picking or timing stocks or bonds is a pointless strategy. If true, we just should buy the stocks index or any ETF and focus on long-term growth, wealth accumulation, income generation, diversification, perhaps compounding returns, and retirement planning and capital allocation. This is the strong version of the efficient market hypothesis. No one can outperform the market. However, the efficient market hypothesis has actually three forms or levels of efficiency: weak, semi-strong, and strong forms. If the strong efficient market hypothesis holds, the first opportunistic strategy is fairly simple, and many actually in the markets use this strategy. I think the majority of investors find an index with good long-term returns and keep saving there. In average, the returns will go up and up on a yearly basis, even if we face a problem such as the pandemic or a crisis such as the global financial crisis of 2007. So carry on feeding your account, and in the long run, you will get the returns that you want. So that is the first strategy. The semi-strong form asserts that stock prices reflect all publicly available information. This includes historical data, financial statements, new releases, economic reports, and any other information. But not all investors will understand which information or the information correctly. Their knowledge is actually imperfect. So, through financial advice and public analysis available, the interpretation of the public becomes more perfect. So, yes, there is a mixed evidence regarding this semi-strong efficiency. While many students show that stock prices adjust very quickly to publicly available information, anomalies, which are opportunities for us, such as the post-earnings announcements, drift challenge this form of efficient market hypothesis of EMH. So here is my take of possible strategies that follow this semi-strong level of efficiency. Earning announcements. Look for earning surprises that are very good. The greater, the better, actually. On the other hand, M&A, merchant acquisitions, usually have positive effects on targeted firms' prices and just mixed results when looking at the firms that acquire other organizations. So the next one is that next strategy, the third one, is that by identifying and investing in stocks that the market has undervalued based on complex or information that is misinterpreted, yes, you will be able to outperform the market. However, let's be honest here. This one is a bit difficult and requires actually lots of research. So sometimes for the small accounts it's not good. Well, it's good to learn, but the profits by the time that you spend on it are not that nice. So the third one, the fourth strategy is get inside information. Obviously, that follows the semi-strong version of the EMH, but it's very difficult. You will need to have someone inside of the companies that you want to invest in. But it's still possible. If you know someone in Amazon, for instance, it will tell you how well they are doing, for instance, in terms of sales or revenues. And if you know someone else that can give you better inside information, so you will be able to possibly beat the markets. In addition, I have actually some practical notes that I would like to share with you. Following this efficient market hypothesis, stay informed. So news are very important, are even more important than possibly technical analysis and economic analysis or financial analysis. So continuously monitor news and financial reports to quickly react to new information. Develop a research routine. So regularly analyze financial statements, market trends, etc., economic indicators. And also leverage technology. Now that we are in the age of AI, I think use tools such as algorithms and AI to react to information faster than many other big players in the market, because they are actually a bit slow. They need processes and they sometimes are time consuming to be able to make decisions about buying. Maintain your discipline. Stick to a very well decided investment strategy and avoid your emotions. I think this sounds weird, but if you follow your emotions, possibly when there is a crisis or a panic in the market, you will just sell and you will lose a lot of money. Rather than if you carry on being patient and play the long run game, sometimes that is much better. The weak form of EMH asserts that all historical trading information, such as past prices and volumes, is fully reflected in current stock prices. This means that any pattern, trends, or data points from the past market activity are already incorporated into the price of a stock. Unlike the semi-strong form of efficient market hypothesis EMH, the weak form does not consider all publicly available information, such as financial statements, new releases, etc. It only focuses on historical price and volume data. So the weak form also does not account for private or insider information. This is considered under the strong form of EMH. So while the weak form asserts that historical data is fully reflected in stock prices, it also acknowledges that certain behavioral and seasonal patterns, such as momentum and calendar effects, might still exist. These patterns can sometimes be exploited by investors, suggesting that even the weak form may not hold perfectly in real-world markets. So, to put it simple, share prices often move in cycles, and that do not reflect the underlying performance of the market. If information is imperfect, those with better understanding of such cycles gain from buying shares at the trough and selling them at the peak of the cycles. They are taking advantage of this market anomaly that often occurs actually in the stock exchange. So increasing numbers of investment analysts are using technical models to track share cycles. As they do so, and knowledge becomes more perfect, so that markets will become more efficient and the cycles will tend to disappear. Jagadesh and Titman, for instance, found in 1993 that momentum effects suggest that stocks that have performed well in the past tend to continue performing well in the short term, while stocks that have performed poorly tend to continue underperforming. This is contrary to the weak form of the efficient market hypothesis. Empirical studies have shown that momentum strategies, which involve buying past winners and selling past losses, can yield abnormal returns in the short term. And this effect actually challenges the weak form by suggesting that past price information can be somewhat predictive. On the other hand, the calendar effect that we have here as a strategy number 6. As example of calendar effect, we have the weekend effect. So stock prices tend to be lower on Mondays compared to closing price on previous Fridays. So if we follow that strategy, that I believe is as well weak, but if we unite that strategy with others, possibly we will have more odds of outperform in the markets. So this pattern has been observed historically in the Standard & Poor's 500 and is well documented as an anomaly that contradicts the weak form of efficient market hypothesis. We also have here the turn of the month effect, where stock prices often rise on the last trading day of the month and the first 3 trading days of the next month. This suggests as a predictable pattern based on the calendar, which should actually not exist if the market were truly weak form efficient. Another anomaly is the January effect. Small caps stocks tend to outperform in the first 2 to 3 weeks of January, and this is attributed to year-end tax considerations and New Year optimism. This anomaly also contradicts the weak form of efficient market hypothesis. So if you like this topic, subscribe and like, so I will know that you want to know more about market anomalies. There are many more, and that will actually improve your game. So please let me know. The efficient market hypothesis suggests that neither technical analysis or fundamental analysis, say looking at financial statements or economic information, economic releases of fundamentals, can consistently yield superior returns than just simply buying the stock index or any other benchmark. In other words, there is no gain from studying a company's performance and prospects, as this information would have already been included in the current share price. However, we will cover this topic later on if you like my video. So I will also cover at what extent the technical analysis and other economic strategies impact the stock exchange. Here's a quick reference list that I use that could help you exploiting anomalies in the markets. Thank you very much, and I will see you in my next video.